Good day and welcome to Rainbow Children's Medicare Limited Q2 FY2024 earnings conference call hosted by IIFL Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference over to Mr. Rahul Jivani from IIFL Securities Limited. Please go ahead, sir.
Good morning, everyone. I am Rahul from IIFL Institutional Equities, and I welcome you to the second quarter earnings conference call of Rainbow Hospitals. From Rainbow, we have with us Dr. Ramesh Kancharla, Chairman and Managing Director, Mr. Sanjeev Sukumaran, Group COO, Mr. Vikas Maheshwari, CFO, and Mr. Saurabh Bhandari, Group Business Analyst. So over to you, sir, for your opening comments.
Well, thank you, Rahul. Thank you. So good morning, everyone. So I'm delighted to extend a warm welcome to this earnings call for the second quarter and the first half of the current financial year. I trust everyone enjoyed the recent festive celebrations. Historically, the second quarter is characterized by heightened occupancy rates, a surge in patient visits, and a favorable financial performance. This year, too, the second quarter displayed positive trends compared to the first quarter. However, certain environmental factors such as the delayed onset of the monsoon and a marked variation in seasonal rainfall, especially pronounced in the southern regions of India, influenced our performance negatively. August was notably drier, a rarity we haven't seen in a century, impacting the typical seasonal pattern and prevalence of various illnesses. Despite these headwinds, we have maintained a consistent and positive trajectory in both our operational and financial indicators. Against this backdrop, I would like to delve into the financial metrics for the second quarter. In Q2 FY2024, our revenue registered a growth of 6.3%, amounting to rupees 332.7 crores. Similarly, our EBITDA saw an increase of 7.3%, reaching to 117.6 crores, and the PAT showing a growth of 2.7%, reaching 63.2 crores. For the quarter under review, our occupancy rate stood at 51.4%, highlighting specifics. Our matured hospitals recorded an occupancy of 60%, which was lower due to delayed onset of season. Additionally, our new hospitals reported an occupancy rate of 35%, indicative of the nascent stage of their growth trajectory. Coming to expansion plans, after a relatively quiet first half of the year, we are now gearing up for a significant expansion in H2. With the plans to add 270 beds, we are launching 3 new hospitals across Hyderabad, Bangalore, and Chennai, which will further strengthen our hub and spoke model in these cities. We have recently inaugurated a modern outpatient block featuring a contemporary IVF facility adjacent to our LB Nagar Spoke Hospital in Hyderabad. This initiative aims to elevate patient experience and support future growth at this hospital. Our new hospital, strategically located in central Hyderabad, with our 60 beds, is expected to launch clinical operations on 14th November, aligning with our foundational anniversary. Another 50-bed additional block at Hydernagar, Hyderabad branch, Hyderabad Spoke, is expected to be operational by December. Our our new spoke hospitals in Annanagar, Chennai and Sarjapur, Bangalore, each with a capacity of 80 beds, are in concluding stages of their construction. They are slated to become operational in Q4 of the current financial year. This encapsulates our project roadmap for the ongoing fiscal year. The rest of the projects, which is the spoke hospital at Hennur, Bangalore, of 60 beds, and the regional greenfield spoke hospital at Rajahmundry, Andhra Pradesh, of 100 beds, are progressing well and are expected to commence operations in the next financial year. In the last quarter, we completed 100% payment to HSVP for 2 land parcels in Gurgaon and received the allotment letter for these land parcels. Efforts are underway in collaboration with the governmental entities to secure possession of these land parcels and to go ahead with the registration process. We maintain a confident outlook, envisioning that this expansion will strengthen our presence in growing cities of Hyderabad, Bengaluru, Chennai, and the National Capital Region. Beyond our growth plans, I would like to shed light on some significant achievements that underscore our dedication to pediatric healthcare excellence. We are proud to announce that our OMR hospital in Chennai, which began its operation in September of the previous year, has been awarded the NABH accreditation. With this addition, 12 of our hospitals have garnered the NABH accreditation. Our commitment to advancing quaternary care has shown tangible results in the first half of the fiscal year. We successfully completed approximately 450 cardiac surgeries and procedures, along with 35 transplants encompassing liver, kidney, and bone marrow transplants. In a landmark achievement, we orchestrated the airlift of an 18-month-old infant suffering from severe influenza pneumonia with a lung failure from the Goa Medical College to Rainbow Children's Hospital, Hyderabad. This is perhaps the first air transport of a child on ECMO therapy in India. This child recovered after 29 days of ECMO therapy and ready to be discharged. This news was extensively covered by the Indian media a couple of days ago. I would like to present another great example of multidisciplinary teamwork where pediatric intensive care doctors, pediatric hepatology doctors, infectious disease consultants, and the liver transplant team work together to give a new lease of life for a 4-month-old child with 4 kilograms coming from the Darjeeling. This baby was suffering from a multi-organ sepsis following a liver surgery and was successfully received a liver transplant, rescued initially, and then later underwent liver transplantation. This baby was kind of discharged very healthy without any morbidities. Rainbow Children's Hospital successfully organized a conference of international and national level of pediatric gastroenterology, hepatology, and nutrition, ISPAGAN, and in association with Commonwealth Association of Pediatric Gastroenterology and Nutrition, CAPGAN, conference between 26th and 29th of October 2023 in Hyderabad. The event was addressed by national and international faculty, and over 300 delegates attended the conference from all over the world. The Team Rainbow, including Dr. Prashant Bachna, the senior gastroenterologist, and Dr. Adarsh Kancharla, one of our promoters, jointly organized the conference. This was well recognized and appreciated the outstanding work carried out by Team Rainbow. The company remains focused on growing opportunities in the medical tourism. Having recently signed a MOU with the government of Tanzania in the presence of Honorable President of Tanzania in New Delhi. The MOU focuses on health cooperation between two countries, and with this MOU, Rainbow will receive significant number of patients for the specialty pediatric problems, especially for bone marrow transplantation, liver transplantations, and complex pediatric surgeries. We have undertaken a pilot project focusing on Six Sigma in support supply chain management. The objective is to refine inventory management practices and drive down supply chain related costs. Recognizing the imperative of leadership in the pivotal phase, we have onboarded seasoned professionals in the diverse domains, encompassing senior level leaderships in learning and development, project and engineering, and core operations. Fortifying our leadership structure is paramount in our vision of sustainable scaling and organizational growth. With this, I would like to pass the mic to our CFO, Mr. Vikas Maheshwari, to take you through the financial update. Thank you once again for joining us today. We look forward to your questions and insights as we move forward. Thank you.
Thank you, sir. A very good morning to all of you, and thanks for attending this teleconference. I am happy to brief the financial performance and key developments of Rainbow Hospitals for the second quarter and the first of FY24. Our operating revenue for the quarter stood at rupees 332.7 crores, reflecting a growth of 6.3% when compared to the corresponding quarter of the previous financial year. For H1, our revenue stood at rupees 619.8 crores, reflecting a growth of 12.7% when compared to H1 of the previous financial year. Our EBITDA for the second quarter amounted to rupees 117.6 crores, marking a 7.3% growth compared to the same period last year. For H1, our EBITDA stood at rupees 205.3 crores, reflecting a growth of 7.1% when compared to H1 of the previous financial year. Our EBITDA margins improved for the current quarter to 35.3%, while for the H1 our EBITDA margin stood at 33.1%. The profit after tax for the quarter is 63.2 crores, marking a growth of 2.7% in comparison to the corresponding quarter of the last financial year. The increased depreciation expense to the tune of approximately 4 crores year-on-year basis, mainly towards the new units, led to the lower PAT growth in this quarter. For the H1, our PAT stood at 105 crore rupees, reflecting a growth of 4.4% when compared to the H1 of the previous financial year. In terms of the operational performance, both outpatient and inpatient volumes witnessed a minor decline of 2% and 1% respectively when compared to the corresponding period in the last financial year. Dr. Ramesh has already highlighted the reasons for the same in the opening remarks. Deliveries which are independent of the seasons grew by 4% compared to the corresponding period of the last year. Our return on capital employed and return on equity for the second quarter was 9.7 and 5.6% on non-annualized basis respectively. For the H1, the ROC and ROE are at 16.1% and 9.3% on non-annualized basis respectively. It is expected to go up as the new units commences operations. Our payer mix continued to remain robust and balanced, with 50% of the revenue coming from the insurance and the balance 50% coming from the cash patients. For the H1, the payer mix stood at 51% cash and 49% insurance. Furthermore, I am delighted to note that our international business now constitutes roughly 4% of our total business for the second quarter FY24 compared to the earlier figure of 2%. I am pleased to inform that our company's balances remains robust with net cash position of 472 crore rupees as of 31st September of this year, and this will support our ongoing capital expenditure plan as outlined by Dr. Ramesh, Chairman and Managing Director. Given our current cash flow and the anticipated internal accruals in the coming years, We remain confident in our ability to complete all planned capital expenditures through internal accruals without any debt financing. During the quarter, the company has invested approximately rupees 55 crore rupees in the capital expenditures. With these insights, I conclude my financial update. I now invite questions and suggestions from the participants. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 0 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitesh Dutt from Bowman Capital. Please go ahead.
Hi, thanks for the opportunity. My first question is to improve my understanding of your business model. So, Rainbow's EBITDA margins versus other listed multi-specialty hospitals are significantly higher, despite lower occupancies and similar in-range ARPO. So, Rainbow's EBITDA is 30% plus typically, and other multi-specialty hospitals are usually at early 20s level. So I just want to understand if there is a structural difference in our cost structure due to the pediatric focused business model, which allows us to make high EBITDA margins.
Okay. Now, obviously, the business model is quite different from adult hospitals. So the Rainbow operates one is that the children's hospitals, the outpatients business is significant. It's about our 30% of revenue comes from the outpatient services, whereas the multi-specialty is about 16 to 18% of revenue comes from that. Second important thing is that our average length of stay is much significantly lower, which is about varies between 2.6 to 2.8. The adult hospitals could be kind of north of 4 days. So, and also when you look at kind of the payer mix, we have a kind of the obstetrics, which are kind of shorter ALRs and a higher revenue generation, and also intensive care services. Our beds are about 30% for beds are in intensive care services, which again generates higher revenue. What actually don't do much of per day revenue generation is routine seasonal pediatric patients are the ones too, but they are bulk of the patients in seasons. So therefore, when you see in the current quarter, our ARPOBs are pretty high, and that is because of the seasonal business is much less because of a delayed monsoon. So which is why our ARPOBs are pretty high. Still, we managed to maintain the industry-leading EBITDA.
Also, that is clear. ARPOB angle is clear. But is there any specific difference in cost structure as well? For example, cost of consumables or employee cost savings versus other hospitals?
The professional cost is the same. We also pay about 23-24%, and the HR cost is more or less similar. Our consumable cost is about there's about 4 to 5, at least 5% varies. In adult healthcare, you have a lot of stents, devices, all those things will be there. So we don't have much of those devices, stents, because we don't do a kind of implants and devices and those stuff. So there's about 5% difference in the supply chain cost.
Understood. Thanks a lot for this. I have a couple of more questions specifically for this quarter. So first is on occupancy levels. You mentioned delayed onset of rainfall and seasonal deficit, right? But is there any other reason? Because occupancies are drastically lower. So 51% is even lower than Q4 of FY23. So that is one. And second, any guidance for Q3 and full year occupancy numbers from your side?
Okay. So it is definitely lower. So what's happened is we are still discovering that what is the post-COVID pattern. So the COVID we were kind of quite muted. the post-COVID 1.5 year has been kind of a very heightened and pronounced occupancies. And now this year, what we have seen is that now we are not come back to normal pattern of the year because of the delayed rains and the seasons. We're still kind of not very sure how the rest of the year H2 is going to go. I think we still due to get a kind of a lot of rains and also how the season is going to pan out. So we expect that kind of normally we expect our occupancies to be around 50%. That is a blended, including the new and including the new hospitals which have come into operations. From the last year to this year, there's about 11% of the beds have been added in the two hospitals. So that is we need to take into the fact, take it as significant. We're going to add some more beds, about 16% of the beds this year. With all this addition of the beds, if you could reach to 50% of occupancies, and we're pretty happy with that.
Correct. And so on ARPOB also, ARPOB has significantly increased by 16%. So any factors that have led to better case mix, and is it sustainable? How sustainable is this improvement? Also, same question, any guidance on ARPOB growth on full year basis?
Well, normally we expect to grow our ARPOB about 5 to 6%. That's because of when you have a lower season, definitely the case mix will be different, and you don't have much of seasonal. That actually gives a better ARPOB, because what remains is that now which are cash generating business. So, and also our case mix is changing year on year, so that is a significant factor. And some price escalation is a second thing. If you look at our international business, it was last year 2%. This year is over 4%. So these are all the macros to kind of have a better ARPOB. But we do expect when the season picks up, the ARPOB will get moderated because of the volumes. Though we do overall better business, the ARPOB will get moderated.
Understood. Last question from my side is on the expenses front. So both our gross margin and OPEX as percentage of revenue are down YOY, and our employee expenses have reduced sequentially, even at an absolute level. So what are the reasons, and how do you see these expenses moving in Q3 and Q4 with the commissioning of new hospitals?
So obviously the employee cost will go up when you have added new hospitals, because our model of a hospital is a full-time doctors, and also we do kind of employ a significant number of people to kind of to train them to be positioned for the future business. But at a group level, what happens is that when you don't have a huge seasonal business, we also try to work around to moderate it in terms of optimizing the cost. We try to kind of take the handle off on the attrition. And also we kind of there won't be any kind of additional payments in terms of overtimes and those things that would get moderated. So this is something which, based on how many new beds are going to come, what is the existing business, which is kind of running high occupancies. Sometimes we do kind of transfer our employees from one organization to newer organizations. We do this math all the times to see that optimize our overall HR cost.
Correct. Thanks. I'll get back in the queue.
Thank you.
Thank you very much. Before we take the next question, a reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Girish Bakru from OrbiMed. Please go ahead.
Yeah, I actually just again wanted to reconcile this gross margin expansion despite fallen occupancies and ARPOB. Why is gross margin higher?
You are comparing it is on year-on-year basis or quarter-on-quarter?
Quarter-on-quarter.
The quarter-on-quarter, definitely there is a lot of change, because if you look at in the quarter first, the occupancies was, I think, in the range of 41%, and this quarter is slightly higher. So there is definitely is the operating leverage which has kicked in. All the other expenses, if you look at as a percentage, has improved because of the operating leverage. There was any questions on the staff cost quarter-on-quarter fall, which Dr. Ramesh, MD and Chairman, has already explained you. One more reason which was that is that in the quarter first, the sequential HR cost has come down, because in the quarter first there was some of one-off payments also because of the senior leadership hiring, which we have paid for the amount, which was not there. And then obviously since the quarter second occupancy was not as per the full expectations, so there was some less OT payments and the escalation of the staff. So that was the reason. Otherwise, if you look at all the expenses in the absolute terms have definitely gone up because of the 2 units, Sholingangur and our FD Financial District has opened up. So mainly is the game of the operating leverage.
Understood. And just if you look at the this overall mix in the revenue which you were mentioning, for 30% is from outpatient, there is high ICU, critical beds contribution. Where would be the surgical mix? How much, let's say, revenue would be from surgical procedures?
The surgery is far less in the children's hospital. Children's hospital is dominantly medical. If you take the obstetric sees it absolutely differently. Overall, surgical numbers, let's put it this way, if you have to look at our surgical numbers, over at group level, we may be kind of just around 8,000 to 9,000 surgeries. So it's a children's hospital. It's mainly a domain of a medical. Lots of intensive care and specialty patients. Surgeries are mainly our specialty side, like cardiac or pediatric surgery, and we do have all the specialties like orthopedic surgery, but the numbers, pediatrics is not wear and tear. Pediatric is acute or genetic. These are the ones, but so it's not comparable with multi-specialty.
I understand, because last couple of calls you were discussing this, the RPOB is highest in your quaternary procedures, which I would assume would include surgery, and obstetrics would come at the similar higher level, and then secondary and OPD would come lower. So the sensitivity of the RPOB, is it higher to surgical procedures or deliveries? How should we?
Quaternary, what we do is in the quaternary basis, the complex neurosurgeries and liver transplants and cardiac surgeries, renal transplants, BMTs, and related intensive care along with these patients. That is the quaternary care, which is a kind of a growing segment in the Rainbow Group. It's all quaternary care is kind of a fairly nascent. It's about 4 or 5 years. The growth of quaternary care is fairly impressive.
So this change in RPOP, is it sensitive more to the deliveries as of now? Is the sensitivity highest there? I'm just trying to figure out what exactly.
I think it's a combination. It is to an extent deliveries, to an extent the complex surgeries, and to an extent it's international, and pricing. I don't think any dominant factor of one of them. It is a combination of stuff.
Understood. And just lastly, can you share of this 755 doctors, how many are surgeons?
The surgeons will be about 10 to 15%.
Okay.
10% maybe outer limit.
Understood. Thank you. Thank you so much for answering questions.
Thanks. Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Rishi Modi from Marcellus Investments Managers. Please go ahead.
Hi, can you all hear me?
Yeah, Rishi, we can hear you.
Hi, Rishi. Yeah. Hi.
Yeah, hi. So first, just a bookkeeping question. The loans that we've given to Madhukar Hospital, how much is still pending for us to receive from that hospital? I think FY23 we had around 40 crores remaining to receive. So Q2, how much is left?
So 3 crore rupees in this quarter we have received. So the amount has got reduced to that extent. So that is the update on this Madhukar one.
Okay. 3 crores that we have received in this Q2. In Q2 or half year?
So we are not too much. This is for the quarter second, which we are just updating you. So we are not pretty worried about this Madhukar loan which we have given. That unit is doing well, and we have learned a lot about this North market. How does it operate? And we are pretty confident that whatever the money we have given over a period of time, we will be able to recover this amount. It is just a time and the money which we have invested on that. And we are pretty sure that this money will get recovered over a period of time. There's not too much of the worry for us right now.
All right. Okay. Second, on the international business front, so we are at 4% of revenue. Are there any? Is there any target that we are targeting over, say, the next 3 to 5 years? And how different is the ARPOB for international patients versus domestic patients? If you could give some understanding out there.
It's a very early phase now. We started our internal business post-pandemic, actually. So what we are trying to do is the two things for us international business. One is that, the build, so far, children's hospital has been kind of presented to the international patients or international doctors. So our approach is to see, first of all, that, the people need to know that what is the Rainbow Children's Hospital and its capabilities. Number two is that influence more at the doctoral level and also have an associations and agreements with the at the country level, at the government level or foundations and other level. Number two. Number three is that, then kind of try to get the other, agencies, those are also there. So work at multi-pronged approach and try to see that maximum coverage for 1 or 2 years' time. So far, there are some of the countries which are kind of very promising the number of the patients what they are sending and all the feedback what we are getting it. So maybe by kind of next year we'll have a better idea about this how we can actually position ourselves. What is the expectations on international business? So on the other hand, what we are trying to do is that establishing quaternary care in the Bangalore and Delhi also. So all these things are going to be important to drive the international business to our network group hospitals. Right now, Hyderabad is a dominant player, and as well followed by Delhi. So we just need to see that balance between all of them. So in the recent concluding conference, which is the Pediatric Gastroenterology Conference of the Commonwealth and the Indian Society, lots of doctors have come from Africa, Middle East, and Indian neighborhood countries like Bangladesh and the Russian countries. They're all seen and appreciative of what we are doing it. They were quite surprised to see that, the Children's Hospital doing all the quaternary care procedures. It is a journey which we have kind of embarked in, and it will take some time for us to strengthen our position and to really have proper estimates. And so far it's pretty encouraging. I think we've guided about 3 to 4%. I think in the last 2 quarters we've been doing 4%, which is pretty encouraging. We just signed with the Tanzania government. The health minister came and visited the hospital recently, and I signed the MOU with in the presence of Honorable President of Tanzania. So they're quite happy to send their children to the Rainbow Network for all the tertiary care and quaternary care.
Right. And if you could just give an understanding of how different is the ARPOB, is there any multiple on that difference versus our company average?
I think it definitely be above the company average, but in the initial phase, what happens is that you wanted to do, and first of all, show them the results. My aim is to see that if the results are better when they are done in Children's Hospital. First, I probably want to bat for that first rather than ARPOBs.
Understood. All right. Finally, you mentioned that you all hired some senior employees in this quarter. Could you just give us a brief understanding on who all have you all hired in this quarter on the operations front as well as on the medical side of things? And what are they bringing to the table? What are their how are you all planning to use their capabilities?
Yeah. So we have hired other senior management in the last 6 months' time. Now, currently, one of the things important because we got a large capex to spend and almost a significant bed expansion. So we need a very seasoned project heads to drive the projects on time. That's one position which we onboarded. And also as we increase the number of units, I think the learning and development is one very, very important area. So because this is a very service-driven, the children's health care. So a lot of focus, emphasis goes on that. So we are trying to kind of work on that. And also that even the sales and marketing space, because Rainbow has always been very, very organically grown. I think sales and marketing space is something which we are trying to build it. Mr. Sanjeev Sukumaran is actually come from a very seasoned background of sales and marketing, operational background. So he's kind of trying to work very seriously on that. So that's something is going to be a kind of going to kind of have a big leverage on that as we move forward with an increased number of beds as we strengthening our hub and spoke model next 2-3 years' time.
Understood. Thank you. That's it from my end. All the best.
Thank you. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Yeah, hi. Thank you for the opportunity. So first question, were there any specific cities wherein the year-on-year impact on occupancies was more pronounced in this quarter, or was the impact widespread for us?
No, Alankar, to be specific, actually, we have seen this mature across the group. I think we have seen that to an extent more, a little more in Chennai. To an extent in Hyderabad and Andhra also. So that's not very notably. I can feel that there's some degree of the seasonal variation. I think largely because of that, what we have seen is that the last year's season lasted till March. So April onwards it became a kind of quietened up, and we have had delayed monsoon, so that good for the society, that healthy period continued to go on till August and middle of September. So what we had is about kind of some degree of seasonal business only last 5 weeks of this quarter. So that's why we see that the occupancy is plummeted to the extent to the tune of 8% in matured hospitals, about 11 to 11.5% in the growing, the new spokes. That's seen across the southern parts. Maybe Bangalore is slightly better than compared to the Chennai, Andhra, and Hyderabad.
Thank you, sir. That's helpful. So the second question is, given the big expansion phase over the next 6 months or so, and I mean even beyond that, but I mean more focused on the next 6 months, possibly this is the highest ever in the company's history. Are there any meaningful execution risk which you would like to highlight here?
I think the execution challenges may be there, but not the risks may not be there. The challenge, always there will be kind of when you commence 4 or 5 hospitals in 4 or 5 months' time, there's a lot of the challenges, execution challenges, which I'm sure with a large team now, we should be able to kind of troubleshoot it. So one of the important things is in Hyderabad is no challenge because enough number of people are there. And Hyderabad, when we do expansions, we always do it for demand. In the last, the financial district, when we done a new unit, which is doing very well, and it's posting significant positive EBITDAs. So therefore, when we do in Central City or additional block in Hydernagar, this is all for demand, what we are doing. So Chennai, when you look at it, kind of we want to expand the hub and spoke model. Yeah, still I would say that now it's a 12 to 18 months break even. And execution is something since we are already there with the 2 units, I'm sure we'll be able to orchestrate. Bangalore, we already have 2 units, and adding 1 more unit is not going to be a big challenge for us. It's the area where we are going to operate in Bangalore is a pretty promising part of Bangalore, which is the Sarjapur, Bellandur area. So a lot of doctors are interested to kind of work with us. So it is in a way for the demand in Bangalore also. So that's why we are kind of fairly confident about though it is 270 beds, we should be able to kind of manage well. Yeah, Vikas?
Yeah, Alankar, if you look at the breakup of the beds which are coming up, out of that 110 beds are coming in Hyderabad, which is our forte, so which is roughly 40% of the beds coming into the Hyderabad. So we are not worried about that. And more importantly, these 2 units are almost ready. And Hydernagar, which is the central Hyderabad, is getting opened in next 15 days time, or 14 days to be very precise. 14th of November, we are opening. Hydernagar, which is just an extension of the existing unit, and is will be opened by December. So we are not worried about that at all. And with this, we will be reaching the capacity in Hyderabad to roughly 950 beds, which is, sizable for the pediatrics and mother and child focused hospital. And as being told by MD, this Bangalore, we have already 3 hospitals, adding 1 more for the growth, and Tamil Nadu 80 beds. And those are in also good shape, so that should get opened by March. The execution risk, more or less, what was, anticipated that on the timeline, etc., I think we are meeting that, and pretty confident that this will get opened on the timelines which is being stated. Is this answer, Alankar? Alankar? Rahul? We disconnected or what?
Hello.
Hello?
Yeah, I guess, sorry to interrupt, sir. I guess that he has disconnected. That's Mr.
Okay.
So I'll take the next question. Thank you. The next question is from the line of Bansi Desai from JP Morgan. Please go ahead.
My question is on margins in this quarter. So despite sharp decline in occupancies, we've reported margins of 35% plus. I understand there was a benefit of case mix, also cost control, which would have driven this margins. But just trying to understand, had this quarter been a normal quarter, would our margins be any different? Just trying to understand, is case mix a bigger driver of margins or occupancy for us?
I think the margins are always with the case mix rather than occupancy. I think what happens is beyond a critical occupancy, then the additional case mix will kick in more operating efficiencies. Because you have the same doctor, same HR cost, same system, everything else. Even if that's what typically happens in the seasons, in the quarter 2 and quarter 3, when you have when you are doing well, on top of it, and season adds to it. So that will kind of push lots of outpatients, that generates a lot of revenue, and also the seasonal business. It's like icing on the cake. So that gives a kind of more of operating leverage, and our costs will get moderated, but you'll have kind of additional the revenues will kick in.
Got it. Thanks. And sir, how has the occupancy trended for the month of October for us? We've heard there has been rise in dengue cases, etc. So have you seen any improved occupancy in this particular month?
So definitely there has been an improvement in the last 2 months' time, and from October onwards. September onwards. So there is an increase in occupancies. But dengues are kind of a very, we do hear very differently from city to city variation. Some places, I think some of the adults are pretty sick, and still a few adolescents are also pretty sick. But mostly the smaller children under 5 years, they are kind of not getting into a kind of a very not becoming critical, requiring intensive care.
Okay, that's good to hear. And my second question is on occupancy. So for the newer beds, we've reported 35% occupancy. So if we were to adjust for the new beds which got commissioned in the last 4 quarters, what would have been the occupancies like for that cluster?
So it would be 40% plus, just over the 40%.
Okay, got it.
Ansi, Vikas Maestri, let me add. So is the lower occupancy we see as an opportunity basically. So that shows the delta which we have got for the growth for ourselves and which can drive the revenue and the EBITDA in the coming quarters as we ramp up the occupancy on these new units.
Got it. Thanks.
Thank you. The next question is from Mr. Rahul Jivani, who's a coordinator for the call, please, from IIFL Securities Limited. Please go ahead.
Yeah. Hi, sir. Sir, would it be possible for you to quantify the contribution of the seasonal business this year versus last year, in terms of how much did it contribute to you?
Oh, it varies from year to year. I think, let's put it this way, it's about, probably about 12 to 15%, I would say.
Okay. So then this year maybe the contribution was lower than this 12 to 15% usual, right?
Yeah.
Sure, sir. And sir, you talked about, let's say, you targeting break-even in the Chennai market for the new hospital, so between a 12 to 18 month period. Can you similarly talk about what would be your targeted timelines for break-even in Bangalore, which is again a home market for us, and then maybe in some of these tier 2, tier 3 markets like Rajahmundry, which you are planning to enter into next year?
Yeah. I'm sure I would expect Rajahmundry to do in 2 years' time, 2 calendar years, 2 full years, and the Bangalore would be the same, 12 to 18 months' time, the break-even.
Sure, sir. And sir, Vikas indicated that the Madhukar Hospital has been doing well. So any operational parameters which you can share of Madhukar in terms of what kind of EBITDA margins the hospital is currently running at? And I think we were trying to convert the Rosewalk Hospital into a normal birthing center versus their previous positioning of being a premium birthing center. So any updates with respect to your plans for the Delhi NCR market in terms of existing hospitals?
So, Rahul, as far as the Delhi is concerned, we are happy to brief that the performance has improved a lot since we provide only the medical services there, so we don't track their operating metrics so closely as we track for all our 16 hospitals. But it has improved over a period of time, and we have seen it is a cash positive, and they have been able to repay our loans which we have given for the operational performance, etc. As far as the Rosewalk is concerned, I will request Dr. Ramesh to brief on that.
No, the Rosewalk as overall there's no bleed from the kind of operational point of view. It's kind of breaking even. So what we are trying to see is it's a small hospital, number one. So as a group, we never believed in this boutique businesses. We kind of not really been big fan of small hospitals because you won't be able to kind of display your strength and your ability to kind of offer the patients a large carta. So this has been a problem of Rosewalk, like many other boutique centers in the country. Okay, so therefore we are constantly trying to see that remove the luxury brand, but unfortunately it's not getting removed. So the people still in the minds of the Rosewalk and say that this is the luxury hospital brand. We have recruited some full-time doctors, and even the doctors' concerns are, okay, this is a luxury hospital, so I may not be able to see large number of patients, so I can't stop my clinic to depend on completely Rosewalk. So there are multiple things are there. Rather, what we are trying to see is we are trying to get a large number of. I'll give the mic to Sanjeev Sukumaran. He is fully into Rosewalk now. So he should be able to give you a little better outlook of Rosewalk. 1 second, Rahul.
Thank you, Rahul. I think a pertinent question, Rahul. So a couple of things that you spoke about. Do we convert this into any other birthing center? And Dr. Ramesh did touch upon that. But I think it's important for us to also know and understand that Rosewalk is in the southern part of Delhi, the South Delhi. So there is a demand for what we call as a boutique center, and there is and though we try to come back to a normal birthing center, there's always been a consistent demand on this. What we've been doing over the last 2 quarters is trying to beef up a team of marketing so that we start to position our brand in a much more compulsive manner. We're starting to see some results on that. We've hired a few full-time doctors, which are very, very prominent in the southern Delhi space. So we're starting to see leverage of that, and we're building those. We're building the portfolio of doctors in that area. And I'm quite positive that over the next few quarters, we would start to see an uptick in what Rosewalk.
Sure, sir. And sir, just one last request from my end. Can we please start disclosing the payer mix and case mix data on a quarterly basis, because that would be helpful to us in terms of analyzing the numbers, and given that most of your peers do or disclose that data, so that would be very helpful. Yeah, thanks. That's it from me.
To that, Rahul, the payer mix, obviously we are covering under our opening remarks, but we will include into our presentation. And we will also explore the possibility of putting up the case mix. Because the case mix which we put up in our matrix in the children's hospital is slightly different. We will discuss offline with you and the others to see how best we can disclose that.
Sure, sir. Thank you. That's it from me.
Thank you.
Thank you. The next question is from the line of Sandeep Jain from Baroda BNP Paribas Mutual Funds. Please go ahead.
Yeah, hi. Most of the question has been answered. Only one question on, new hospital and ALOS and all. So, the advantage what we have got in the RPOP is the reduction in the ALOS and a couple of other things, but which is largely happening in the new hospitals, right? If I look at the year-on-year basis, the new hospital ALOS has declined from 3.67 to 2.9, and as such the occupancy also. So, how we are looking at it means in terms of if I look at occupancy, ALOS going ahead, or in terms of the growth overall going ahead, what kind of ALOS or what kind of occupancy we are targeting in the new hospital with the new bed and all, so that I can get a more sense on the RPOP. Yeah, that's the first question, and there is one follow-up.
So as far as the new units are concerned, as they mature and whatever the matures, hospital are showing the RPOP, ALOS and occupancy. We believe that will also be our new hospitals, which is not matured less than 5 years, which we are classifying, will display the same type of characteristics, plus minus 6 months, 1 year here and there, but they will reach there. So we see this as an opportunity for the growth, which can come from will come in the coming quarters from the new hospitals.
And up to the desired level of occupancy of somewhere around 50-55% kind of thing, how much time we can take?
So from the date of the operation of the hospital, it takes 4 to 5 years time, and obviously we'll reach there.
Okay. And by the end of this year, we have somewhere around 100 new beds are coming. Is this calculation is right?
So 270 beds we are opening in the next 5 months.
Yeah. Okay.
And which will get commissioned by 31st March.
270 new beds. Okay. Fine. Yeah.
270 new beds. Great.
Thank you.
Thank you.
Thank you. The next question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Yeah, sorry, I got dropped off earlier. Just one final question. If you look at Bangalore as a market for us, we've been present for about 8 years now. So in terms of the margin trajectory in this cluster, would it be fair to say that over a period of time, the margins in this cluster would largely be in sync with our margins in the Hyderabad market, or would you like to say that Hyderabad, being a home market, will always have that advantage for us compared to any other geography we enter into?
Yeah, I think the margins in Bangalore have been fairly good, and as the hospitals are maturing, we can see that one of the hospitals is actually almost reached to the Hyderabad level. But I'll tell you, Hyderabad is always will have a kind of advantage about the home advantage will always be there in terms of your pricing power, in terms of your kind of case mix, maturity. All these things plays up. It's not only with Rainbow, it's home ground for every group of the hospitals displays that strength, and I think Rainbow also displays the same strength. But that doesn't mean that now Bangalore will be significantly lower. But Bangalore for the city, what I think we would continue to be a kind of a industry leading in Bangalore as we move forward next couple of years' time.
Understood, sir. That's helpful. Thank you and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi. Thank you for the opportunity. So most of the questions have been answered. I have two clarifications. First, are you done with tariff hike for all the clusters which you intended for this year, or something is yet to be done?
Yes, Damayanti, we have done
We have done most of the negotiations, and all the tariffs been negotiated with the TPAs. Yeah.
So all been done, and then maybe we will see in next cycle only. But for time being, it's all fixed, all negotiated, as you said.
Yeah. Most of them are closed actually.
Okay. And my second question.
There is also Hyderabad was pending when we spoke last time. That's also been closed.
Okay. My second question is on ARPOB again. So 16% year-on-year growth. Can you broadly help us understand what is the contribution here from price hike, and what kind of contribution came from case mix, so that I guess we have understanding about the drivers better?
Damayanti, we have to look at a kind of a yearly ARPOB. That's what it is. We have guided earlier about 5 to 6% yearly ARPOB growth. But what we are seeing at the moment is that now the second quarter to now is 16% ARPOB growth. This is largely because one is that we don't have seasonal business. Number two is our case mix. Number three is our kind of price optimization. Another significant reason is about the international business. So all are put together. I think we had a significant. Suppose if this quarter had been had a significant season, about another 10 to 12% of occupancy increase, that would have got optimized significantly to somewhere around 52,000 or 51,000. That usually happens year on year to us. So we can talk about ARPOB on a year-on-year basis rather than one quarter comparison.
Okay. So, sir, this annualized 5 to 6% increase in ARPOB, will it be mostly driven by the price hike part, or other factors like mix and all will also play important role?
We expect significant to be in the case mix. Factor number one is the case mix. Factor number two is the international, and number three is price hike.
Okay, sir. Thank you.
And also, Damayanti, if you can go through the presentation, slide number 23, if you look at the most of the ARPOB growth as a percentage, if you look at, has come from the new hospitals, right? So the new hospital ARPOB for the H1 has grew by 30%. So that shows that those hospitals, started gaining the pricing power, plus the clinical mix is going up on those hospitals. So that also helps.
Okay, understood. Thank you.
Thank you.
Thank you. The next question is from the line of Dhiresh Pathak from White Oak. Please go ahead.
Thank you. So the OMR and the financial...
Dhiresh, I'm sorry to interrupt you, but your voice is not audible. Could you speak a little closer to the mic? off from your headset.
Sure. Is this better?
Not really.
Hello, am I audible now?
Please
speak up a bit.
Okay, sir. I was asking that last year the OMR and Financial District, the newer spokes that we had opened, their occupancy and their break-even, if you can just talk to that.
I'll tell you we don't give up unit-wise this one. I can give you overall broader. OMR is given a broader guidance. So I think that this year, by end of the year, we will be a break-even OMR Rainbow. So Financial District, I think we are already break-even this year. By end of the year, we'll post positive EBITDAs.
Okay, great. And just on this reclassification, so Rainbow Children Hospital, this is Madhukar, right? This has been now moved to mature bucket.
Yes. Yeah.
So that has also then impacted the ARPOB of the newer and the mature, right? Because you don't count the bed capacity, but you show the revenue, right? So that's why I'm seeing lower ARPOB in newer bucket versus and slightly higher ARPOB in the mature bucket. Is that also one of the reasons?
Yeah, that is one of the reasons. And Dhiresh, this will continue to happen because the sizable hospitals which are under 5 years as not mature will move to the mature. So that plus minus will continue to happen. But what is more important to see at the at the group level, what type of metrics we are showing, and all the new units how they are progressing to the metrics to achieve the mature hospitals metrics. So I think we are focused more on that.
Understood. Okay, thank you so much.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi. Good afternoon. Few questions. One is, sir, in a previous question you mentioned that even though in Bangalore we are now 10 years old, the profitability matrix for the Bangalore cluster will is currently below what the profitability matrix Hyderabad market has. But if I extend it over the next 5 years, and the whole idea of the whole proposition, and I could be wrong here, is that we are able to take market share from smaller clinics or from smaller independent practitioners, which means that even in markets like Bangalore, where there is a lot of incoming crowd, our brand should be able to gain a premium over the pricing which would be prevalent. So when do you see that a market becomes good enough for us to improve the profitability? Because eventually the profitability for Bangalore or Hyderabad or any other cluster should not be too different as our brand keeps gaining scale. So that should be the proposition, right? Or am I understanding something wrong here?
Yeah. Well, so what happens is we are eighth year of operations in Bangalore. So in Hyderabad we are about 20 years of operations, right? So right from it's purely a maturity and your pricing strategy, the overall how your business makes, and also the number of the operating metrics are all very different. I mean, you can look at even adult hospitals which are home-based. All other hospitals will display the same because of sheer maturity, and also your cost structures also. Revenue generation dominates over the cost structures. Of course, very impressive returns. So that is the home ground effect, number one. That doesn't mean that other cities we don't do well. So I would say in the next 5 years down, we will be absolutely a super dominant player in Bangalore. There's no doubt about it, because that is But when you look at the your hiring, your inclusion of the doctors, what is today versus what was 10 years ago is very different, right? Isn't it? If I want to hire a doctor, if I want to hire a manager, today from now to future is very different. Cost structures have changed. So, which is why you may do a top line very well. You may have a good EBITDA. You may have a very well run hospital. Still, that original hospital where you started, commenced, that will never match that. So, I think that's my understanding of it. But one thing I'm very sure is that any home base of any healthcare chain displays the same pattern. That doesn't mean that other cities people have not done well. People have done very, very well in other cities because Fortis has done very well in Bangalore. So that's not a question about it. So we will do very well in Bangalore, Chennai, all those domains. But that kind of a comparison, I don't know. It's how do you compare with that? It is always home ground and your control on what's happening at micro level. That's what I would say.
Okay. But just one question here. See, in a multi-speciality, there are multiple areas where a hospital can focus on, say, oncology, or someone could be very strong on cardio. While in a children's hospital, what I understand is that those permutation combinations of multiple specialties is limited because children don't have all those. So very rare issues might be happening, but on an average, the infection pattern or the disease pattern would be similar across geographies. So eventually, because there are not many permutations and combinations which can come on the specialty side, the treatment or the treatment focus for a children would be similar whether it's in Hyderabad or in Bangalore. And as the brand or the presence of the brand gets felt more and more, the footfalls would come inherently for the company. We should be able to pull the footfalls. So I'm just trying to understand, for a specialty, I understand that home market makes a big difference and we've seen across chains. But for our kind of a model, would the home market versus a Bangalore or a Chennai or any new market, eventually it should even out or it should converge to a similar profitability?
Yeah, we can talk on this subject for a really long time because it's still multiple parameters. You see, for example, to Hyderabad, if someone comes from a 250 kilometers, just to show them that the jail is all right, okay? From Hyderabad, they come to Rainbow, just to show them that their jail is okay because they know, they've heard this Rainbow is the best children's hospital. So this is a network, this is an effect of a longevity and also brand which is penetrating not only in the city, into the kind of a people of the rural. So there are many factors will be there in that. The city factors are to an extent, but in the larger picture, the multiple factors works around. And also, what is important in children's healthcare is the destination. So, children's hospital is a destination. It is not like adult hospitals. For 10 doctors moves, patients also moves along with them. In children's hospital, it's a destination effect. So-and-so hospital is so good. It is a destination for everything. People just come to you because it's a destination. It's rather than a kind of a hospital. Few doctors moving around, they won't be able to take patients. So, which is why the maturity of the hospital is an impression. It gives a lot of positive impression among the public, and not only in the city, in the peripheries, across the state, beyond the state borders. It's a large subject we can discuss.
Sure. Moving on to second question. This is more, one clarification first. So you said on the newer hospitals, we are at 40%. So the older hospitals, which were not added in last, say, 1 year, our occupancies are around 40%. Is that the number you mentioned earlier?
No, in the matured hospitals which are old, we had about 60% occupancy versus 68% occupancy in the last year.
Correct.
So without addition of any beds, there is a 8% drop in occupancy.
Yeah.
That is because of the March season kicked in.
Correct.
Is what I was saying.
No, my question was on the newer hospitals. So if I average out, say June 22 and September 22, last year first half versus current first half, we've added on an average we were at 448, 500 to now 600, or around 130 beds have been added. So on the older beds of average count of 320, we are at 40%. That was the understanding?
That's true.
Okay. Okay, fine. Sure, thanks a lot. Yeah.
Thank you. Thanks, sir.
Thank you. As there are no further questions from the participants, I now hand over the conference over to the management for the closing comments.
Thank you, everybody, and participating on the conference call. We would look forward to receive any other further questions if the participants have. They can contact Mr. Saurabh Bhandari or myself. The email IDs and the coordinates is already given in our presentation. Look forward to meet all of you in the coming quarters. Thank you very much.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.